If you wake up every single morning, look at the charts and have no clue where price wants to head or what price wants to do, then this video is for you. And what I'm about to explain to you is my 3-step framework that I personally use on a daily basis to help me get consistent results. This framework has not only made my trading very simple, it has helped me understand the timing of when to take a trade, the location of where to take a trade, and most importantly, the direction on where the market wants to head. And after trading and backtesting this strategy for years, I can confidently say that this has helped me change the way I trade and take the guesswork out of my trading. Let's get into it. So in today's video, we're going to go over how to find daily bias and more importantly, what daily bias is, why it's important, and how we can use it in our trading. And it all starts off with the higher time frames. And what I have here is a 3-step solution and what I personally use on exactly how to identify daily bias. Number 1 and 2 being the most important, and number 3 is an added bonus. So number 1, what we have here is the direction of the markets. What are we looking for coming into market open? What's going on the higher time frames? Number 2, the location. Once we understand the direction, we have essentially quote unquote our bias for the day. Now let's go on to the location. Where are we going to be taking trades from? Just because we understand the bias just doesn't mean we can blindly look for entries. In number 3, what we have here is of course our entries. This is primarily done on the lower time frames, and this only can be done once we have the location and once we have the direction in the market. So number 1, we have to determine direction, location, which is our higher time frame points of interest and what we can also call our daily bias, and then we can make our way down to the entry. And with that being said, this is my last 30-day P&L using what I'm about to teach you in today's video, using my simple 3-step solution on exactly how to determine daily bias and how to incorporate it in your trading. So first things first, what we're going to talk about here is the direction of the overall markets. If we can nail down the direction, it's going to be a lot easier when we're trading on the lower time frames. And to simply put it, it's basically asking ourselves, are we moving higher? Are we in an uptrend? Or is price moving lower and we're in a downtrend? It's as simple as that. Of course, it's going to look a little bit different on the charts, but it's basically asking ourselves, are we moving higher or are we moving lower? One of the simplest ways to determine if price is moving higher is simple market structure. I'm going to quickly, briefly go over this, but if we're making higher highs, higher lows, higher highs, higher lows, this is a simple uptrend in the markets. And what we can be looking for is longs. Same thing towards the downside. If we're making lower lows, lower highs, then we can be looking for downside, right? What we have here in this case is bearish market structure. Price is continuing to push towards the downside. So based off of these 2 scenarios, these of course are going to be the best trading opportunities when price is trending higher or when price is trending lower. We'll talk about range here in a second, which is something that is going to be a little bit more trickier to trade. We'll talk about the scenarios and how, if we understand there's range in the markets, what we can do in this case. So first, let's talk about range. Range is basically when price is in between key levels of support and resistance. When we're bouncing off the lows, rejecting off the highs, this is what's called range/consolidation. Generally speaking, if we're continuation traders, we do not want to be trading in ranges. In my opinion, ranges are some of the most hardest conditions to trade because ultimately there's no clear direction on the higher time frame. So it's very hard for you to have conviction on holding any trades because majority of the trades are going to be mean reversions/reversals. Second, what we have is an uptrend. As you can see here, price is moving towards upside. As you can see, the daily chart's fairly bullish, making higher highs, higher lows, higher highs, higher lows. As you can see right here, price is moving nicely towards the highs. And then finally, what we have here is a downtrend where price is doing the opposite. As you can see, price is moving lower, lower highs, lower lows, lower highs, lower lows, and we're pushing towards the downside. So as you can see, these are the 3 scenarios that we can be looking for specifically on the higher time frames. Some things to note. And when I'm looking for higher time frame trends in the markets, the time frame that I'm going to be on is the daily chart. The reason being is because it gives us a great overview of what the overall markets is doing. If I'm on the 1-minute time frame, the trends can change fairly quickly. Whereas the daily chart, it takes a full day for the candle to form. And that's going to give us a lot more clear of a picture on what the higher time frame wants to do. The next question is, how far should we look back? Since we understand we should be looking at the daily chart, next is the time. In this case, we want to look at the most recent price action. And what's a great rule of thumb to look at is the past 20 to 40 days. You don't need to look back the past 100 days worth of price action. You can look back at the past 20 to 40 sessions and it gives you the best estimate on what price wants to do today. If you go back 200 days, it's going to be very hard to understand. But if you're looking at the past 20 to 40 days, it gives you a great overview on how bullish or how bearish the markets are. Another tip that I do have is that if there is no trend, there is no trade. It's as simple as that. If we don't have a clear uptrend or a clear downtrend on the higher time frames, then there is no trade. And that is specifically for continuation. We're going to talk about reversals here as well and how that can impact our trading. Next, what we're going to talk about is location and why location matters. Just because we understand the trend, for example, let's say we're trending towards the upside, we know price is bullish. That doesn't mean we can just blindly buy. We have to be looking for key areas where there's good risk to reward in order to take trading opportunities. I'm going to talk about my favorite location here in a second. As I mentioned, just because we're in a clear uptrend doesn't mean we're going to buy as price is moving higher. What we want to be doing is looking for key areas, essentially key pullback areas where we can go long to trade this back towards the upside with minimal risk. We don't want to buy at the highs just because we're bullish. We want to be buying in key areas of support where it makes sense to trade back towards the upside. And as traders, we're looking for good areas of risk to reward where it makes sense for us to place a trade. And what are some of the best levels that you can place trades from? As you can see right here, what I have is a daily candle. And a daily candle high along with a daily candle low are areas we should keep an eye out for. The reason being is because there's the most liquidity resting above and below these areas. And with that being said, there's always going to be nice trading opportunities. Either we can be looking to sell into these key areas or we can be looking for buying opportunities at these key areas. So the first thing that we can do is mark out the high and low of the daily candle. In this case, what we have here is our previous day highs along with our previous day lows. Then we can refine our levels / box in the previous day highs and lows. As you can see right here, what we can do is draw it from the wick to the body. Same thing towards the downside, we can box this in. And these are going to be our key areas in price. I personally like using areas. You can use levels if you like. I personally find it that if you draw areas in price, it's going to give you a little bit more wiggle room and leeway so you can make less mistakes. As you can see right here, what we have is a chart example. This is 1 day's worth of price action here on the 15-minute time frame. What we're going to do is mark out that previous day highs, box that in. We're going to mark out our previous day lows, box that in, and that is going to be the key areas of interest that we're looking for price. So this is the location and where we want to be placing trades from. And now I'll talk to you about the continuation in the reversal scenarios. So what we want to do here is wait for a clear direction in the markets. And this is specifically for trending markets / continuation. As you can see right here, what we have is the daily time frame. Now we have that 15-minute chart. We boxed in our previous day highs along with our previous day lows. What we're going to be doing is waiting for a break above our previous day highs or a break below our previous day lows. This is specifically for continuation, as I mentioned. If we want to see a move higher, it's going to have to break above our key points of interest. If you want to see a move lower, similar thing. It's going to have to break below our previous day lows. It's as simple as that. If price wants to move higher, it needs to break above key levels. If it wants to move lower, it needs to break below key levels. What does this look like here on a chart? As you can see, we have that previous day highs boxed in. Price pushes towards the upside, breaks above it, retests, and we had that continuation. We're going to talk about entries in a bit here, but this is one of the scenarios that we're looking for. Break above, retest, continuation towards the upside. Now, what does this look like for a ranging market? So we know for a fact that if the markets are not having continuation, most likely that's going to turn into a reversal or a range. So in this case, we have the exact same levels marked out, previous day highs along with our previous day lows. What we're going to be doing in this case instead is looking for the potential rejection. So if buyers step in, we could be looking for this reversal back towards the upside. For example, if sellers step in off our previous day highs, then we could be looking for a trade back down in towards our previous day lows. So as you can see here, there's plenty of different examples in what we could be looking for coming into any given day. Key levels that we have marked out, previous day highs, you can see price in this case trades up in towards our previous day highs, rejects, and that's when you could be looking for this continuation move back down in towards that previous day lows. So as you can see right here, this is the location and where we want to be taking trades. And it all stems from old highs and old lows. Some of the easiest levels that you can have marked out, of course, is our previous day highs and previous day lows. And there's going to be two scenarios for both upside and downside. So every single day coming into the market open, you can have two scenarios for upside, two scenarios for downside, and based off of the reaction that we have off those levels, you could be looking to place trades from. What you have to understand is our job as traders is to react to price off certain levels. What we do not want to be doing is predicting price, because if we try and predict what price wants to do, that's when we're going to lose trades pointlessly. If we react to what price is doing at certain levels, that's when we're going to have our edge in the markets, because that's when we want to react to price and see the price action that we have off those key levels. And finally, what we have is our entry. I'm going to touch up on the entry a lot more on the examples that I'm going to be showing you guys here in a second, but the entry of course isn't as important as number 1 and number 2. Number 1 and 2, the direction and location, are the most important things when talking about bias. Number 3, entry, is something completely different, and that of course is done on the lower time frames. So number 1, right, focus in on the higher time frames, which is determining your bias, right, the direction of the overall markets. Number 2, the location. These two of course are the most important when determining the bias. And of course, number 3 is just our entry model. And as I mentioned, we'll go into examples here now since this is the last step, and it's only valid if you get the direction and the location correct. Now, with this being said, let's go on to some examples to show you exactly what we have for us today. So as you can see, we're on my first example here. We're on Tesla, currently on the daily time frame. As I mentioned, what we can be looking for is the past 20 to 40 sessions, because that's going to give us the most relevant price action. Just by looking at the charts here, just on this daily chart, you can see that we're clearly in a downtrend here in the markets. Every pop is being shorted, lower highs are being built, and now we're pushing towards the downside. So just by looking at this chart, we can see the overall market is clearly in a downtrend. So with this being said, now we understand that the trend is bearish. So now we can go on to step number 2. Step number 2, as I mentioned, what we can do is mark out our previous day highs, and we can mark out that previous day lows, and now go on to the lower time frames. Now that we have the high and low marked out, we can go into the 15-minute time frame, draw out our key areas and price. As I mentioned, we can draw it from the wick to the body. So now we understand that this is the location and where we want to be taking trades. We can be looking for a couple of things here. Number 1, which is going to be my favorite scenario, pop and fade off our previous day lows for this continued push towards the downside. This is really the only short scenario that we have here in the markets. Another possible scenario, if we break above, we can look for a potential mean reversion back towards the upside. But of course, this isn't as ideal because the higher time frame is bearish, as I mentioned. So we much rather be looking for shorts towards the downside. So in this case, we'd be looking for the short off our previous day lows. So now let's play out the tape. So as we play the tape coming to market open, as you can see right there, price pushes up in towards our previous day lows. Sellers are stepping in, indicated by these upper wicks. And then as you can see, this candle right here breaks below our previous candle low. This is a sign here on the higher time frames. If you're looking at the 15-minute, super strong rejection right here off our key levels. Sellers are stepping in nicely. Go back onto the lower time frames. This is exactly where we can go looking short with a stop loss just to break above. And now we can be looking for low of day plus continuation towards the downside. In this case, what I'm going to be looking for is just a fixed risk to reward, which is going to be a 1 to 2, just to make it nice and easy for this example. Now we can play out the tape. And as you can see right there, price ended up having a super solid push right down in towards our key take profits for a super solid win on the day. And as I mentioned, this was based off of number 1, the higher time frames. So it had a clear direction in the market, followed up by a super solid location, which was that previous day lows. And then for our entries, it was a nice and easy break underneath that previous candle, stop above, looking for that 1 to 2 risk reward towards the downside. Now with this being said, let's go on to the next example that we have for us today. So as you can see, I'm on my next example here. I'm currently on Intel on the daily chart. And as I mentioned, if we're looking at the past 20 to 40 sessions, you can see that Intel is fairly bullish here. We're making higher highs, higher lows, higher highs, higher lows, and we're pushing towards the upside, and we're having a really solid push higher. So now that we understand that the trend is moving higher, now we can go on to step number 2. And step number 2 is simply marking out our previous day highs, and we can mark out that previous day lows, and now go on to the 15-minute. Now, with this being said, let's mark out our key levels. We can drag this over. In this case, we have multiple touches, so we can move this up in towards our high that we created back here. And then of course, we can mark out that previous day lows, and let's just mark out this general area here as well. So now we've currently boxed in our previous day highs. We boxed in our previous day lows. As I mentioned, the higher time frame is bullish. So if you do want to see upside above our previous day highs for a continuation towards the highs, if we want to see some downside, which we would not be looking for, it would be the rejection here off that previous day highs for a potential push towards the upside. But of course, the higher time frame is bullish, so we're going to be looking for upside. Let's play out the tape. As you can see, the very first candle, immediate retest off that previous day highs and push towards the upside. Of course, this could have been an entry, but it would have been very aggressive. But now we can wait for a opening range retest or some sort of down close candle. As you can see for Intel here, what we can mark out now is our 5-minute range high. So what we can be looking for here. So now what we can be looking for here on Intel, since the higher time frame is bullish, we can be looking for the reclaim, or we can be looking for the retest here off our 5-minute range high for continuation towards the upside. As you can see right here for Intel, we're getting that nice strong candle close, immediate retest here off our 5-minute range high as well. This is where we can go look long with this stop loss just to break below this key level. So this is going to be our stop, looking for a continuation towards the highs. In this case, we can target a 1 to 2 fixed risk to reward. And now we can play out the tape. And as you can see there on Intel, super solid reaction there off our 5-minute range high. Came close to our stop loss, but never closed below. Ended up reclaiming nicely and pushed back up and towards our higher time frame objective. And as you can see right there, the reason why we were able to hold this trade was because of the higher time frames and the relative strength that we had intraday. And just based off our entry, of course, this was a more aggressive entry, but we could have done that because of the higher time frame, as I mentioned. That being said, let's go on to the last and final example that I have for us today. So as you can see right here, I'm on the daily chart. I'm on a ticker called Circle. And as you can see, we originally pushed towards the downside, but in the past 20 to 40 sessions, we ended up flipping back bullish. Big gap up here, nice push towards upside. A lot of buyers are stepping in aggressively. So originally we were bearish, but now we're flipping bullish and we have lots of momentum. So I'd say we're bullish here on the daily chart, right, in the past 20 to 40 sessions here. Now we can go on to step number 2. Step number 2, of course, is marking off our previous day highs along with that previous day lows, and now going on to that 15-minute time frame. Now we can box in our previous day highs along with our previous day lows. So coming into today, if we are wanting to see some upside here on Circle, we like to see a previous day highs break for that continued push towards the upside. If we want to see some downside, potential previous day high rejection for a continuation lower. But as I mentioned, higher time frame is bullish, so what we much rather look for is, of course, longs towards the upside. Play out the tape. So as you can see right here, Circle, nice push towards the highs, couple rejections here now offer previous day highs. What we'll be doing here is waiting for that break above, as I mentioned, above that previous day highs for that continuation towards the upside. As you can see right here, price is now pushing towards the highs. We're getting this super solid retest candle here now on this next candle, confirming that buyers are stepping in. This is where we can go look long with the stop loss just underneath this candle low. And now we can be looking for is a 1 to 2 risk reward back towards the highs. Now let's play out the tape. And as you can see right there, super quick move towards the upside, but super strong buyers that stepped in right off that previous day highs for that nice continuation towards the upside, as you can see. But with that being said, as you can see right there, this is exactly how to use daily bias and incorporate into our trading, understanding the direction of the overall markets, and of course, then going on to the location, and then finally going on to the entry. So I hope you guys found some value out of that video. If you did, appreciate if you guys drop a like and sub. With that being said, I'll see you guys next week for a brand new video. Peace.